Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Pick and choose your own best-of-breed insurtech and data providers with Advantage Go's ecosystem. Today's podcast is one of the most positive and optimistic I think I've ever recorded. Andrew Horton, Group CEO of QBE, has been in the role long enough to have been able to reap some of the rewards of the changes he has made at the global insurer since he took over the top job. Having dealt with legacy issues and posted some remarkable results that have validated his strategy, the mood from this interview is 100% forward-looking and upbeat. Andrew's QBE has a spring in its step and a growth plan to execute into a global insurance and reinsurance market that seems to be throwing up opportunities almost wherever you look. It certainly helped that this was recorded on a pleasant early spring day in London, with plenty of sun in the sky and blossom on the trees. But the difference between this interview and the last one I did with Andrew 2 years ago is palpable. Today, Andrew is buzzing with energy and good humour and has audibly grown in confidence. In this discussion, we make light work of all the issues of the day, taking in topics as diverse as reinsurance, D&I, the long-term trends of facilitisation and algorithmic underwriting and their consequences, Lloyd's in the London market, and ensuring the transition. So listen on as we take a world tour of market opportunities and a refreshed and revitalised player looking to seize the moment. If you're feeling jaded and in need of a tonic, this is just what the doctor ordered. Enjoy the podcast. Andrew, welcome back to the Voice of Insurance.
Yeah, thank you for having me back, Mark. It's great to be here.
Oh, it's fantastic. I can't believe, we were just saying before I pressed record that it's over 2 years already, but you said it felt longer.
I don't know why it felt longer. I thought it was nearer the beginning of my 3.5 years, because I've now been here at QBE 3.5 years.
That's quite a long time. I suppose is time going slower, or is it going faster, or is it just harder with the time zones?
I think it's speeding up. It's definitely speeding up. I think being in Sydney just under 3.5 years now has been great fun. The time zones is the major challenge.
I went out to Sydney when I was 15 years old and I haven't been able to make it back. My aunt emigrated out there in the 60s and we had a fantastic family Christmas there once, and I've always wanted to go back. It's because it's a wonderful city.
Mark, you're welcome to come at any time. I keep inviting people. Very few people have taken up on my invitation.
Well, we've got that on the record now that I'm going to be
definitely come down,
descending upon you.
Exactly. We've got plenty of room.
Right. Okay. What about the market? Let's run through the market. Where are you seeing the best opportunities at the moment? Obviously, you have an incredibly global view of things.
Yeah, I think the beauty about the company being in 26 countries and a diverse product set, there are opportunities in quite a lot of places. And I'd like to see growth in almost every area in 2025. A few areas of management liability are more challenged. If we look at specific areas we're focusing on, we're looking at growing QBE Re in 25. We're looking at our facilities. So these portfolio solutions we have here in London, we're looking to grow our accident health business in the US, looking to grow our cyber business. Cyber was quite small when I first joined. We continue to grow on the cyber business.
Well, I had members of your cyber team on the podcast.
Yeah, no, so thank you for doing that. And I thought they came across remarkably well. Of course, I listen to your podcast regularly, specifically the QBE people, but also everybody else as well.
But actually, they did come across really well. Well, it's a very plausible opportunity when you think, I suppose as an industry, we're getting near to $20 billion, but we're not really scratching the surface.
No, I think there's a great opportunity there. And QBE, when I joined, we did have a cyber book and it's working pretty well, but we are looking to grow it, join it up more, look from a global perspective, and we have this great opportunity of doing it in all areas of the company.
Out of all those opportunities you just described, which ones are you most excited about? Ones when you're looking at the budget for next year and thinking, right.
Well, I'm excited about all those. Those are sort of specific ones, but I'm looking at growing almost every area. We've got a great position in the mid-market in Australia. We're the dominant insurer there, so we can continue to grow that. And we're looking at modernising. So other areas as well. I'm really keen on QBE Re. It's been about 10% of our premiums. We'd like it to be slightly larger than that, growing it in a really balanced way. And Chris Calori, who must have been running that division for probably a couple of years now.
And I had him on the podcast, actually, probably, again, a couple of years ago.
If I keep naming people from QBE, you'll just say, you've either been on the podcast or be out to be on the podcast. So,
no, but actually, he came across really well because
he does.
I suppose that was a business, again, that was slightly resetting what it wanted
That's right.
to do.
Well, he's done that, and now we've got it in a good place. Now we want to grow from there. I think that's very similar to what we've been doing with the whole company. When I joined, we had parts of the company working incredibly well. Some were not working as well. And what we've been doing over the past 3 years is remediating the areas that haven't done well, pulled out of one or two things. And now we feel really excited that we have everything we want, and how do we actually build from here? That's why growth in 25 is quite hard to talk about specifics, because I'd like to grow almost every area of the company.
Well, that's incredibly bullish. when you look at the rate adequacy dials, perhaps sort of slightly turning south for the first time, is that sort of okay because they're coming from a very good place and from a very adequate place?
I think that's the key. I think almost everything we've got is rate adequate at this point in time. It looks as though in certain areas it's going to dial back, but there's a reasonable number of areas that aren't. We'd say the wholesale market here in London is under more pressure. We've seen more competition in Australia as we've seen some London capacity come into Australia at this point in time. And we've seen management liability being quite tough for the past few years. But other than that, almost everything else looks pretty good.
I suppose most balance sheet carrier CEOs that I've had on the show have said similar things to you.
Yeah.
So I suppose you can't all grow without the dial shifting further back.
No, I think you're right. But if we look at our US business has been in heavy remediation for a year or two or three, and it has some excellent businesses from financial lines to accident health and so on. Good positions, and we have not tapped out yet in the size we can be. And we now have the US in a good place, and therefore it's looking and thinking differently from where it was before when it was mainly thinking about remediation. It takes so much energy remediating things. It's remarkable, isn't it? If you've got a small part of your portfolio not working, the amount of energy that goes into that. And that means you don't put as much energy into things that can grow. Now we don't have to do as much of that. We have this opportunity to look at things we can grow, which is very exciting for us.
Switched off the distracting things. Is it sort of like the 80-20 rule?
I definitely think so. If not 90-10, it's just remarkable the amount of effort that goes into it.
And once you wake up the first Monday morning, that you don't have to deal with the thing.
That's right. Yeah.
Anymore.
I think the 2 lost portfolio transfers we've done, where we have cleared out or removed some of the reserve risks from 2020 and earlier, is a good thing for us. We don't need to worry about those. So everything we're looking at now is sort of in more positive territory than we've ever had it.
Coming into this interview, I was looking at the annual results, which I thought were excellent. And one of the really marked things, I think the QBE of 5 years ago or 10 years ago, in the year that we just had, we'd had plenty of catastrophic activity. I think you would have picked up more of it. And you've had more explaining to do to investors.
Sure.
Of course, the story was almost that you'd sell through it, actually, and absolutely massively reduce the volatility. Yeah. Is that more like having dry powder in some way, that you could take on more volatility if it was being well paid for?
No, that's exactly right. What we've been doing is trying to dampen down the volatility of old, looked at the portfolio in a very granular way, looked at areas we were overly exposed, reduced those. And that means we have the portfolio in pretty good balance. It's never perfect, but once you've got it in good balance, then you can look at how do you grow it without putting it out of balance. So what we're spending a reasonable amount of time on is getting it back into balance, which takes time. Getting businesses off your balance sheet is not easy. So now we have it in a good place. Yes, we do have dry powder. We would like to grow. And it's much easier to do it from a position of strength rather than doing it on something where we had potential volatility. That was one of the key things I wanted to do, and my leadership team and the rest of the organization wanted to do when I joined 3.5 years ago. It's not surprisingly, see if we can increase the margin of the company and take out volatility. And 2024, I think, was an excellent year for the company where both came to fruition. It was a relatively highly catastrophic year, and we came under our catastrophe allowance. That's despite bearing a reasonable size loss in New Caledonia, which is quite unusual for most insurers.
It's closer to Australia.
Exactly, that's right. So we support
most.
the Pacific Islands quite rightly. So it was good coming in the cat allowance despite that. And I think it was the first time the company had hit plan since 2016. So it's been a long time coming to actually hit the forecast.
It's nice to be able to tell investors.
It is. Investors respond positively to it, which they did in 2024. So that was a real confidence boost, I think, for what we've been doing over the past few years.
I suppose it's my job as a journalist to speculate. For others, when the cycle starts to turn down a little bit, we look towards M&A for growth. Do you think that's likely in your case? It doesn't sound like it is from what you've just said. You've got so many different growth opportunities everywhere that you need to be pursuing those rather than buying other people.
Technology, data and AI are driving change in the insurance sector, and staying ahead of the curve can be tough.
That's why the Insurance Network provides cutting-edge conferences, breakfast briefings, webinars and reports to help you navigate the changing insurance landscape, make the right investment decisions and optimise your operating model.
Discover how industry leaders and insurance experts are leveraging new technologies at events such as TinTech London Market, the DA Strategy Day, London Market Claims and Data Jam.
You can also become a member and join a community of insurance practitioners driving transformational change in their businesses.
Search the Insurance Network to find out more.
That's the Insurance Network.
Yeah, I think that's exactly right. I think buying companies is tough to do, especially on the underwriting side. So we'd rather grow organically. And I think having a more stable platform means more people want to join us. So that makes organic growth that much more easy. And therefore, you don't need to do inorganic growth. Doesn't mean we would never do it. So if we saw a great opportunity that was complementary to what we did or added to a line of business we were in, we'd definitely do it. But it's just tough to do. So I'd rather not be distracted in doing that.
Yes, I think I asked you this a couple of years ago, was sort of, do you see QBE as being something that's already been built in some way, that the main infrastructure, go and build me a global insurance company? It looks like that happened quite a long time ago.
I think so, because the beauty about QBE compared with others markets, the balance we have, because we've got about 25 to 30% of our business in Australia, New Zealand, Pacific Islands. We've got about 35 to 40% of our business international, so that's based out of London, which is UK, Europe, Asia, and Canada. And then we've got about 35% of business in North America. So we have a better geographic balance than almost any other insurer in the world. So it's a question of how do we make the most of that? And what we've been doing over the past few years is leveraging the expertise across those three divisions, which historically they ran quite independently from each other.
Yes, actually, let's talk about that, because that's certainly been one of your stated aims of trying to really join people up.
Yeah.
And I think perhaps with the cyber, that was one of the first classes where we obviously, because I have those people on the show, and you could certainly see that they were creating a global way of approaching the market. Sure. Have you got any other kind of success stories within that project? Because you're a large business and it's easy for you to say them, but it's hard to execute those kind of things, isn't it, when you're sitting on the ground?
No, I completely agree. And therefore, there's an initiative called Bring the Enterprise Together, which I put myself as a personal sponsor because I was so driven that this was going to be a good idea for us. It is hard to actually see. I'd say doing the lost portfolio transfers is a really positive thing because that brought the organization together. These are the portfolios we need to look at. These are the counterparties we need to work with. And that was a company-wide initiative to do that. The cyber one is definitely a specific one, which we're doing across the company. I'd say the product committees we've set up, so we're sharing knowledge, whether it's property or financial lines across the company, which historically we didn't do. They just ran independently. And many of the things that are going on, they may start in the US, but they sort of happen throughout the rest of the world. It's worth knowing that before it actually appears here in Europe and then on to Australia or the other way around. So I think that knowledge sharing has been a major breakthrough.
And I suppose you've got the technological platform sorted out where that can all happen, where all that data is coming in wherever it is in the world and you can share it.
I'd like it to be better. So that's always a challenge of sharing data. I think we've got enough. Data's an interesting one because data's like an endless quest. There's an endless quest for getting more and more data. And my challenge with the organization, let's use the data we've got before we start on a data hunt, trying to find every element of it. So I think you're right. We have enough data within the company to know what we're doing between the various divisions to share to the benefit of the overall group. There's still people out there who would love even more data.
You can become addicted to it because obviously there's your data, but there's tons of third-party data that could be gleaned from all sorts of other places.
Yeah, so you can be forever testing yourself of have you got enough to make any decision. And we've got to remind ourselves we're underwriting day in, day out, and we're paying claims day in, day out. So we must have enough data to actually do this. And we've just knocked out a relatively good result in 2024. So it's not as though the data's telling us something which is incorrect.
Yeah, and you could be hooked on a lot of very expensive subscriptions by the end. A lot of this third-party data is not cheap either.
Yeah.
So what about AI? Is that something you're excited about, particularly when you're looking at analysing all that data you've got, your own data, and saying, well, we've got this huge gold mine of data here. We've been underwriting for a really long time all over the world in practically every commercial class of business that exists.
Yep.
Are you finding any good applications for AI?
I think AI is an interesting topic. I find AI is something I need to continue to learn about. A lot of people want to come talk to me about AI, which is very nice of them, and I've had a lot of presentations on it. And I was likening it last week to being in the fog. So I'm in the fog and all of a sudden it clears and I hear someone talking about AI and they tell me about it and it sounds very exciting, and then they throw me back into the fog and I wonder what have I learned from that till I find another person doing it. So AI has been an interesting journey for us. I think it's a great opportunity for the industry because we get loads of unstructured data in on underwriting and claims, and AI is really good at summarizing, looking for things within it. So it's how to use it to the best of its ability in a controlled way. So that's what we are trying to do. We have launched like a cyber co-pilot. So growing our cyber business as a cyber co-pilot out there, which is looking at submissions coming in and assessing whether they are in line with what we would like to underwrite. So that's been good. That's increased the productivity of our cyber team. Now, what I want to do is scale it. There's no point in just having one team doing it. So we're looking at how do we actually use it across domains rather than in particular lines.
It's a good market. And also what you've just said We want to get everyone to grow, and it doesn't matter
Sure.
what percent it is, but it'd be wonderful to be able to grow at 20% and not have to grow the team 20% and
Exactly,
all your
that's right.
expenses 20%,
Yeah.
because this Copilot's going to be helping you doing that.
That's what we're trying to do. So we're trying to apply it, not surprising, to underwriting and claims, not have too many people experimenting with it, because the danger with AI, we can all go into ChatGPT and other forms of AI and would end up with endless experiments. We're trying to control it more and have a material impact on the efficiency of the company. Ultimately, we should be able to do insurance much more productively than we currently do. And that must be the aim of it. And that's why I'm really excited about it, because there's been nothing like it so far. It's how to apply it as well as possible.
Yeah, and at your scale, you'd only have to make very small incremental gains to make a massive difference.
Yeah. So that's what we're trying to do. We sort of stand back. How do we actually apply it to the claims world, or how do we apply it to the underwriting world, rather than doing very specific things? There is the other point that you made, Mark, where you can use it to scan your data. So you could use it to look across the myriad of systems we have. QBE was built up through a number of acquisitions between 2000 and 2010. Not surprisingly, we don't necessarily have the best technological stack that we'd like, and you can use AI to scan all of the different systems to try and bring things together and get insights you wouldn't be able to get very easily by looking at the systems if you were a human. So we're trying to do that as well.
Well, something that probably follows on from this is you're one of the largest supporters of different facilities,
Sure.
particularly in the London market.
Yeah.
And AI perhaps being part of that, helping to allow you to analyze a portfolio
The data, yeah.
more quickly and then make that decision whether you want
Yeah.
to support it or not. Yeah, how do you see that facilitization? I presume it must have been something you've deemed successful as an experiment, because it's not just an experiment.
That's
It's
right.
now
I've been doing it quite a while.
it's a big line now.
Yeah, I think we write just over $1 billion
Yeah.
of facilities, so we're probably one of the market leaders in it. Some of the facilities we've had for more than a decade, which has been good. Generally, they've worked out well. Our costs are definitely lower to run the facilities. I like the idea of having a balance of open market underwriting and some portfolio underwriting, and I quite like that. So they have worked well. They get good diversification. You can get diversification within the facility and then between the facilities. So it's been a successful line of business for us. I believe they'll continue to grow. There's got to be a balance somewhere, happy balance of between the facilitization and the open market underwriting. So they can't grow too much. And then added to that is the algorithmic underwriting, which we've also just announced we're supporting Key, which is good, which is another way of trying to make insurance as efficient as possible. And I've been a fan of that the whole time I've been in the industry. And I think these help that.
Where do you think that balance lies in terms of how much of the market, particularly we're sitting in London in this global commercial insurance, syndicated insurance market, that big excess market?
Yeah.
What sort of percentage do you think it could be?
Mark, I wish I knew that, because people are testing the boundaries of it, aren't they? So we've seen some of the facilities growing in
I
terms
suppose
of
the market will
percentage.
decide, won't it?
I think it will. It's hard to imagine it being more than 25 or 30%. It's hard to imagine that, but that's probably because I can't imagine it, because that's as far as they've got so far.
If someone wrote a 5% line, but they swung the other 95% beyond them, it would suddenly look a bit monopolistic.
It would be, yeah.
And then
So-
actually the brokers would go and say, well, we need to support another leader in this
Exactly,
market
that's right.
because this underwriter is behaving in a monopolistic way. They seem to think they've stitched up the whole market. In which case, so we know the market would not like that. And the other brokers would go and immediately create another $2 billion facility
completely
with someone
agree.
else. And then end up being competing with each other and probably end up, the market forces would reassert themselves, wouldn't they?
Yes, I completely agree with that. And I think we're still testing it, aren't we? We're just testing how large they can be. I think we've proven they can be larger than where they were. And others are still setting up facilities. So although we may have some been around a while, there are plenty of facilities that could be organised. You made a point, most of them are London-based. So there's no reason why a facility's got to be done out of London. There could be a US-based facility, an Australia-based facility, or something else. And that hasn't really been done to a great extent yet. And I still see that
Certainly
as an
there are
opportunity.
rumblings that certainly some of the broker facilities are starting to be, they don't have to be London-led
That's right.
at all.
I agree. So I think we may see more non-London ones. London and Lloyd's has had the infrastructure to do them in a relatively straightforward manner, so they may not be as easy elsewhere.
Yes. What about London in terms of, we're in an interesting time in London, and we're doing this interview in London, and we're at a time of transition for Lloyd's, for example. It doesn't often happen that there's all the stars come into alignment, that we have a new CEO and a new chairperson and also a new CFO all at the same time. Anyway, when you're over here, I'm sure that you're first on the list of, oh, Andrew's over, must have him over for a fireside chat. No one really has firesides in their offices anymore, so it can't be a fireside chat, unless it's at some old sort of club somewhere in the West End. But
I do try and catch up with key people at Lloyd's when I'm over. They're very generous with their time. So I'm looking forward to that over the next couple of weeks.
If they were canvassing you, what would be the top of your list of things to say, right, if you're asking me, what would you like them to do? It's more of the same?
Yeah, I think it is. I mean, I think they've done a good job over there. I'm not just saying it because I happen to be here and I'm seeing them in the next few days, but I think they have done a good job. So they've focused on performance, which is good. So the performance has been excellent. They're focusing on how to make the market more efficient. They're focusing on bringing more people into the market to make the market more substantial. So I think it's more of the same. I guess it's how they do it. So with the new people coming in, they can always look at, can we do it differently, better, build on what's gone on before, which I think new senior people should be looking at. Really keen on promoting the market still, so they can continue to promote the market around the globe, which I think currently has been done well. So I would have thought it's going to be mainly a build. But you never know. When new people come in, they come with different ideas, new views of things.
And in terms of getting some of the digitization, getting that done, was that the top priority?
Yeah, no, definitely. I would say we can transact insurance more efficiently through digitization, so let's continue to work on that. And I think we've got the market behind these initiatives, which is excellent. They're just not easy to do. I mean, doing that just for one company is hard enough. So when I look at QBE and trying to modernize QBE is not that easy, or even one region of it. So when you're doing it as a whole market, that is not an easy thing to do.
But I suppose there is that opportunity clearly with that facilitization opportunity as that globalizes. If London was properly digitized, that could be a no-brainer for the global broker to say, well, I've already done it in London, therefore I can just switch it on for the rest of the world.
No, I completely agree. London has sort of led the way on the facilitization front.
Yeah, and then it could really be a business opportunity for London. So that premium flow would be technically London premium flow, wherever it was.
Yeah, I agree.
You mentioned about reinsurance, obviously being keen on writing reinsurance through QBE Re. How's the reinsurance world treating QBE? Obviously, you buy reinsurance as much as you sell it.
Sure, it's fine. I mean, we're really happy with the program we've got for 2025, which is good, which is very similar to 2024. We've been able to buy down a bit lower in 2025 over 2024, which is a reflection of external validation that we've managed the portfolio better, which is good. So our retention's a bit low.
You've got a better portfolio.
Yeah, exactly. We've got a better portfolio. So retention's dropped from $400 million to $300 million, which is good for us. I wish the reinsurance market held the same position, pricing, in 25 over 24. I don't see why it came off a bit, which it did. It was only in 23 and 24 that it sort of hit its peak. So I don't really understand that. I'd like the reinsurance market to be as boring as possible, Mark, and pricing just stayed the same, because then the primary insurers would follow. Whenever the reinsurers give away a bit on price, not surprisingly, the primary market moves with it. So it was good. We have great relationships with some of the major reinsurers of the world, which I really appreciate. Continue to build on those, again, which has been excellent for us. Fundamentally, the reinsurance program is very similar in 25 over 24. I just hope pricing holds during this year. But of course, we all know that depends on what actually happens, amount of capacity coming in and all that sort of stuff.
You know, normally it's Q3 and Q4 that are the ones that the journalists have to spend the time poring over the cat losses. But now it doesn't seem to matter when it is.
No.
I think we've also had some early Midwestern storm activity as well over the weekend. And of course, started the year with a $40 to $50 billion wildfire.
Yeah, sure.
Loss.
Yes, which is a massive loss and probably one of the largest reinsurance losses in a long time. You may not know this, but there has been cyclones in Australia. That always sort of gets dropped off the map. Now I'm running a more global insurer.
No, I saw it's been at the Gold Coast.
Yeah, exactly, that's right. It could have been a lot worse.
It wasn't a bad storm, was it? I didn't check my storm.
It was potentially going to hit Brisbane directly, but it moved north of Brisbane, therefore it wasn't as bad. But there are still thousands and thousands of claims coming in. So so it has started off as a relatively active year already. So we'll see how the market responds to that.
Yes, if a reinsurer is looking for any resolve, I don't think it needs to look that much further. So this is probably the worst Q1 we've ever had. So
yeah, keep beating records, don't we?
3 more Qs to go.
I know, exactly. Yeah, I'm sure we'll have a quiet quarter at some point.
Well, we won't, will we?
We may do. You never know. We may do. I'm hoping we will. It's always one of the things, I think it was last year, we were above our catastrophe allowance, or very close to it the half year, and then came well under it at the full year. So things vary enormously. I think our de-risking strategy is working well. We announced our LA loss at about $200 million when we announced our full year results. That's not bad because historically we've taken larger losses in catastrophic events in the US than that.
But I suppose that's down to re-underwriting and looking at limits.
Managing the portfolio, bringing it in, not taking on too much risk, getting more balance. Great fan of balance.
Well, something about balance, the big debate we've been having for the last couple of years on the casualty side of things. Where are you standing on it? We've had quite a lot of activity on reserve strengthening, that kind of thing. And obviously lots of loss portfolio transfers, all sorts of activity and perhaps an admission from some that some of those years in the mid-teens weren't that great. And then obviously a wide debate about what has happened since the pandemic just before. Where do you stand on it?
We're hoping it's an opportunity for us because we stood up a large commercial casualty team that joined us about 2 to 3 years ago now. So we're hoping we've got the timing just right for writing it. The beauty is with that line of business is that limits are much less than they used to be. Pricing has moved up a bit and you can be quite selective in what you do. As you say, our loss portfolio transfer is picking up some of the casualty reserves from 2020 and before. It's an important line for us. You have to keep an eye on the social inflation that everybody bore in the late 2015 to 2020. But it seems to have, if you can ever settle down, it doesn't seem to be continuing at the rate it was, Mark. So we feel pretty comfortable about writing casualty in the US at this point in time.
Good. Well, so another one of your growth lines.
No, it definitely is. It's gone from nothing to $250 million last year over a 3-year period.
But I suppose also having that situation where most carriers have really trimmed their line size.
That's right.
Before, maybe 10 years ago, you had to have a line size of 100 million or something before the broker would actually pay any attention to you, whereas presumably now you can do much less.
You're down at 5 to 10. So I think that's the beauty of it. You can really manage your portfolio with limited lines now. So we need to keep an eye on whether that starts creeping back, which is always a key indicator of a softening market. At the moment, that's not happening.
We're in interesting times and perhaps more unstable times than when we last spoke. I don't think anyone could really argue that. Let's focus on one thing. Last time we spoke, we were talking about ESG, net zero activities. What does that change perhaps in the political winds do for a business like QBE? You're present in so many countries in the world on things like net zero, sustainability, ensuring the transition.
So Mark, you've hit an important point, haven't you? Because the challenge is if we're operating in North America, Europe and Australasia, then everybody has different views about what should be going on. So from a sustainability strategy, we had 3 legs to our sustainability strategy. One is how to get us and our clients to a net zero position. One is having a very sustainable workforce. We'll talk about that and how do we ensure we look after our people as well as possible. And one was underwriting good things for the future and investing in good things for the future. So those are the 3 legs, and we continue down that strategy. So we continue down the strategy of working on a net zero position, continue to ensure we focus on our people, and we invest relatively heavily in things which are going to be good for a sustainable planet going forwards from an underwriting and investment point of view. So haven't changed our strategy on the back of it at this point in time.
I suppose the winds blow one way and then they blow another, but the tide seems to be fairly inexorable. That the net zero tide is probably the right side of history, isn't it?
Well, ultimately, this is where we've got to go, I feel. So it's just a question of how we get there. So let's be as supportive as we possibly can. So say the first element is talking to our clients. We want to support our clients. So let's talk with our clients about how we help them.
Ultimately, the demand is of the insurer, isn't it? It's hey, I'm going to build a new wind farm. Can you insure it?
That's right, exactly right.
You're not creating the wind farm.
No, exactly. If we can help them do that, then that's a good thing to do. So that's our aim. Similarly, if we can help people transition, then that's our aim as well. So we're going to support many people as we possibly can through the transition.
Certainly, we've seen also a change in those attitudes at high corporate level, perhaps in the US, to diversity and inclusion.
Sure.
They tend to describe it as diversity, equity and inclusion. Is that a difficult position to be in? Again, because you're in so many countries in the world, do you feel any heat from what's going on in the US?
So we've got to be mindful of what's going on everywhere. But I've had questions from the US and elsewhere from QBE people around what are we doing? And our view is we continue down the strategy we've been going down, which making QBE as inclusive an operation as we possibly can. From a pure gender diversity point of view, we have done remarkably well. So we have an executive committee which is about 55% women, 45% men, a board which is 45% women, 55% men, so it's the other way around. And generally throughout the organisation, we have more than 40% of women in the senior roles. So we've done well on that, and we get external validation for it. I think that has stood the company in good stead. So we continue to focus on being as inclusive as possible.
In the end, that's good for business, isn't it?
It is, that's right. It's just a good business thing. I think it's good for the people in the business and it's good for the business. We were very proud, not that I want to promote just one thing. So there is Equileap, which does an analysis of 3,250 public companies, and QBE came 4th out of this group regarding its D&I. So we are very proud of that, having moved up from 80-something a year ago. So it's something we are being recognized for, and I think that attracts all people to the company. It doesn't just attract one group of people to the company, it attracts everyone to the company.
And I suppose the core is really, is it good business?
I'm really keen on it. I think it stood the company in great stead.
And if you don't have to spend so much money on recruitment consultants because you have much lower turnover of staff, then these are measurable savings for whatever that initiative has cost you. It probably pays back a return.
Yeah, turnover is in a really good place, and we've been able to attract some great people. So that's good.
Andrew, I was looking at my long list of questions, and I think we've come to the end of what I've managed to think of. Normally, I always describe them not as questions, but conversation starters. So is there any other direction you think the conversation should have gone that it hasn't gone yet? And so here's your last chance.
Mark, I think you've covered almost everything. We've done a good run round over what's been going on in the company and the broader world. I really enjoyed talking about it, incredibly passionate about what the company's been doing over the past 3.5 years and looking forward to the future. Hopefully that's come across.
I think it has actually. Well, I did listen back to the previous one. In fact, no, I used AI to run a transcript of it for me. And I read through that. Yes, you got a lot more energy this time.
It's interesting to say that, because the CFO said to me that a couple of the shareholders said, we haven't seen Andrew so positive. I thought it had been positive for the previous 3.5 years when I've been meeting the investors, but they're obviously seeing something in that. And I think it is this refreshing approach that we're looking at everything. All of our businesses are in really good shape. We're looking at growth more. Of course, we can't time the market perfectly, but the market's not in too bad a place. So this is a great opportunity for us in 2025.
Excellent. I suppose you can never really time the market, and you have to be in the market all the time anyway.
Exactly, that's right. I completely agree.
I mean, be slightly more in than sometimes than others.
Yeah, that's it.
Great. Thanks very much.
No problem. Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.